Now, in the private markets, credit markets, we talk about a debt spiral. And a debt spiral is that part of the cycle when the debtor needs to borrow money in order to pay debt service, and it accelerates, and then everybody sees that and they don't want to hold the debt. That's where we're approaching.
How soon before we get there then?
If you are interested at all in where mortgage rates are heading, you may even actually think you know where mortgage rates are going. You're going to want to pay attention to this. Ray Dalio is suggesting that the US government is getting close to defaulting on their debt and having to do things they would never have to normally do.
You are going to see shocking developments in terms of how that's going to be dealt with. Things that may not have happened in our lifetimes, but things that have happened throughout history.
So in order to understand mortgage rates and where we're heading, we need to understand that it's all based on the ability for the federal government to borrow money and what their interest rate is.
So how concerned are you about the accelerating pace of government borrowing and the borrowing cost, which will affect families in the form of higher mortgage rates?
Yeah, we don't comment on fiscal policy other than to say, as my predecessors have said, that the U.S. federal budget is on an unsustainable path.
We have seen the Federal Reserve already cut rates by 75 basis points, but the 10-year Treasury yields have been rising. So the Federal Reserve is not lowering the mortgage rate. And the reasoning for that could be that we have very high budget deficit.
I know what you're thinking. Well, Doge is coming in and they've been haphazardly cutting. Surely that's causing a dent in the deficit.
Hey, Brian, so for all the talk in Washington recently of cutting federal spending, we have yet to see any of that show up in the official data. Treasury's latest statement shows that overall spending hit a record high for the month of February, and spending and the overall deficit are both now at all-time highs for the first 5 months of the fiscal year. So the deficit today is about 17% bigger than it was this time last year, and that's due to spending up at nearly every agency.
You'll be shocked to find that the deficit this year is much worse than both last year and the year before. We've already hit $1 trillion deficit for this year. Now, according to both Scott Bessent, Ray Dalio, we're running a deficit about 7% to GDP. It really needs to be about 3% to GDP. What that means is probably the max deficit you can run in a year is $1 trillion if you want to get this on firm ground. We've already hit $1 trillion for fiscal year 2025 in the federal government. This year is already a bust, but Scott Bessent has a plan. They're cutting employees as fast as they can in the federal government.
Because right now we have excess employment in the government, and those people can be moved to the private sector.
When you say that when we're in a period of detox, you used that word on CNBC last week. Is that a euphemism for recession?
Not at all. It doesn't have to be, because it'll depend on how quickly the baton gets handed off. Our goal is to have a smooth transition. But I tell you, Sarah, the easy thing for us to have done would have been to come in and just keep this massive spending level going. And it's unsustainable, but could we have kept it going for a year, 2 years, maybe even 4? Maybe, but you're risking a financial calamity.
Check this chart out. Now, this was Anna Wong reposting this, but this was from the University of Michigan data. And you can see it's starting to feel like there may be a recession. People are feeling like they're going to lose their jobs. They're very concerned about it. The problem is, at the same time, we're starting to see inflation expectations unanchor and move higher. Now, there's a term for this. It's called stagflation. We could have higher interest rates and be in a recession at the same time. That is a very real possibility.
Diane, good to see you.
Good to be here.
So let's just, I guess, define our terms here, what we're looking for in the way of stagflation. I guess, essentially risks on both the growth and the inflation side that might keep the Fed static for a while?
Exactly. So the economy is slowing. There's no question about that. And in fact, the drag from government spending, we know that cuts to social programs and transfers to nonprofits, contracts, all of that ripples through the overall economy. That's dampening growth. The Fed's also worried about is this time around we have this muscle memory, and you saw it in the NFIB index as well. We recently raised prices. In the 2010s, we not only had well-anchored inflation expectations, they were set in cement. Now we've been through a period where not only do consumers expect some level of inflation, but we saw in the NFIB index that actually the highest number of small businesses are raising prices already, and that is something they didn't do in the past.
So that's
since 2021.
Right.
We have massive tension in the mortgage market. 2 weeks ago, I was convinced that we would see a 5 handle this year. Now today, I'm convinced that we might see mortgage rates in the 8. I just don't know. And neither do you, and neither does the Federal Reserve or Trump and his team, even though they're actively working levers they can pull to reduce rates. So if you are thinking about buying or selling, and if you are trying to factor in mortgage rates into your decision, the best thing you can do is use the rates you have today and the tools you have today and make a decision based on that. Speculating on where rates will go will not help you. You do not know. They could go to 8, they could go to 5. I don't know. I wish I did. I wish I was naive enough to think that I knew. I sat in a room full of realtors about a year and a half ago that were so sure that mortgage rates would be dropping that they were talking about ARMs and all these products that they could offer their buyers. And it all turned out to be very predatory because lo and behold, mortgage rates never dropped. I think if you want to lower mortgage rate, there are ways to do that. I've talked about mortgage assumption. I helped somebody just a month ago get a 2.5% mortgage on a house. We paid fair market value for it. They didn't pay any additional. I just got a contract, helped somebody else get in contract for a mortgage in 2.25%. It's crazy. They're going to get a 2.25% mortgage. So it is possible to get mortgage assumptions and get a lower rate. But the fact is that if you need to speculate on where mortgage rates are going to go, you are playing a very dangerous game. The number one danger about buying a house is being reactive when you have to buy or when you have to sell. Don't be reactive. If the rate is lower than what your current mortgage is, you should refinance. Don't wait for it to drop further. Go ahead and refinance. There's no restriction on you refinancing again. Just make sure you're factoring in the cost of the refi and either getting it covered by taking a higher rate or knowing what the payback period is with the monthly payment you're saving. And with that, I hope you guys have a great rest of the day. Listen, be careful out there. If you are thinking about buying a house, I hope people in Nashville would love to help you. I look forward to seeing you next Saturday. Thanks a lot.